everyone, welcome back to my channel Accounts by Amrita. Hope you all are doing good. Now let's recap what we have done in the previous videos. We looked into the cash book and inventory valuation. Now we are going to look into buying and selling of goods on credit. A credit transaction takes place when a buyer purchases the goods now and pays for them at a later date. There are some documents which are used in a credit transaction. These are order form or purchase order, credit note, debit note, statement of account, delivery docket, invoice, receipt. So now order form or purchase order is a document used by a business to show that it intends to buy something from another business or supplier. It is issued by the buyer to the supplier. Information that needs to be included in the purchase order form are document name, reference number, date, name and address of the buyer, name and address of the seller, clear description and quantities of the products required and prices of the products required. Invoice. It is a business document issued by the supplier of a product and sent with the product being supplied. Its purpose is to describe exactly what the buyer has purchased, the price of each item, and the total price. Invoices are also used when customers are buying a service. When issuing invoices, business owners should make sure they show date of the purchase, name and types of goods sold, quantities sold, prices, total value of the goods sold, name of the customer, date when the payment is due. Credit note. Supplier issues a credit note to the buyer when number 1, goods are charged for an invoice but goods are never received by the buyer, or goods are received but are in a faulty or poor condition, or are not the correct goods the buyer wanted and are returned to the supplier. Number 2, goods received and invoiced are not ordered and are returned to the supplier. Number 3, the supplier has made a mistake in adding up the cost of goods sold and has charged the buyer too much. Delivery docket. Its purpose is to prove that the goods have been delivered to the buyer. Often it is signed by the buyer to prove that the goods have been received. Statement of account. It is issued by the supplier to its customers, usually at end of each month. It is used only for credit transactions. Receipt. It is a document that is taken as a proof that the payment has been paid and received. It's time to look through the journals which we use to record these credit transactions. We use cash book, stock book, purchase journal and sales journal. We have already looked into the cash book and the stock book in the previous videos. Now our main focus would be on purchase journal and sales journal. So purchase journal is used by a business that purchases goods on credit from its suppliers. They use it to record the detail of goods purchased on credit and payments made for them. It is mainly used to account for the goods purchased on credit that are intended for resale. Items purchased on credit from the supplier are required from the supplier on credit that are required to be used in the business would normally be recorded in a different journal called general journal. Sales journal is used in credit transactions. Its purpose is to keep track of sales and to account for the goods sold on credit by charging its receivable on the debit side of an accounts receivable account and crediting the revenue on the credit side. Alright, in the next video we are going to start doing some exercise questions, so stay tuned and wait for that. Thank you guys for watching this video. Wait for the next video. Don't forget to like, share and subscribe. Till then, bye bye.